So I understand that, and so you have a lot of experience in consulting, in advising organizations, very big international organizations, governments, such as the World Bank, IMF, and also the UN, and also some African countries. And you focused on basically, let's say, fintech, or the one element of it, and their applications, particularly in developing countries, let's say more Africa. So this is very, very interesting. And I understand that you have your old academic background, master's degree and PhD degree from Oxford University, and obviously is a very strong academic background. And then, but you are related to law, to that area, and then you apply to fintech or financial related or institutional theory. So, and now you are an assistant professor in a very good university. So I hope you enjoy academic, and I hope, it's not easy, but, we know what we are doing. And today you are going to talk about, mobile money, which is very important in Kenya, as far as I understand. I'm also related to some work with AERC. So we saw a lot of people who have been talking about the application of fintech, particularly mobile money, in Kenya. So today you are going to talk about the one particularly is a product that is related to Safaricom, which is a very, very big network in Kenya. And I'm very curious about, so I heard some other stories about money, mobile money, and et cetera, et cetera. So I'm going to actually, maybe I will have some questions related to your presentation, and I'm sure my colleagues will have a lot of questions as well. So I actually, without further ado, I will give the floor to you, and you take your time, and you talk about your research and see how we can interact.
Great. Thank you, Hong, and I hope. Thank you, Hong, and I hope I'm pronouncing your name correctly. Thank you to everyone for coming. I'm delighted to talk today with you all about this research. SOAS is a school that I've always actually wanted to become more involved with, and so this is a real thrill for me to get to have this interaction with you. I'm going to start by hoping that I haven't messed up the technology. Can everyone see my screen? I really hope so.
Yes, we can see.
Yes. Excellent. Good. So I managed to pass one test. So that's great. So thank you all for coming, and good morning from the USA. I'm going to talk to you today about MESO institutional change and the fate of the shadow payment system in Africa. And this builds on my PhD. This builds on further research I've done on institutions and mobile money and the shadow payment system since I completed my PhD 8 years ago. Fieldwork in Kenya, Tanzania, Ghana, Uganda. So I hope you find it interesting. And please do stop me along the way if you want to clarify points or ask questions. I'd be very happy to pause and answer questions as we go. So my question for us to consider today is what will shape the future of the shadow payment system in Africa? And I'm going to define what that is, mobile money, all these different non-bank payment systems. And what I will argue is the answer is whether political actors have incentives to create what's called MESO institutions, which lower transaction costs that will result in more innovation in the shadow payment system, or raise transaction costs, which will result in less innovation. So what I essentially do is to argue that the driver of innovation, one of the key drivers of innovation in the economy, is not macro institutions, which is the work of Douglas North and Acemoglu, Johnson and Robinson, Nobel Prize winning economists. They focus on what I will define as macro institutions. I will argue that meso institutions are also important. And then I will use the shadow payment system in Africa, particularly mobile money, as a case study to demonstrate the importance of meso institutional change for innovation in all economies, including the shadow payment system. So I'm going to be talking about summaries of 3 book chapters of mine. One of a book that I'm writing, that meso institutions are the missing middle of institutional analysis. I will apply the idea of meso institutions to understand the trajectory of the shadow payment system, and I'll zoom in to study meso institutions in mobile money agent networks. So the theme is going to be these meso institutions. What are they? How do they work? How do they evolve over time? We tend to ignore them in institutional analyses of innovation, but I'm going to argue they're central. So if we start with this idea of the missing middle, I like to think about big questions, for better or worse. And so the big question that I've pondered for a long time is, why are some countries rich and some countries poor? Now, of course, a bunch of other people have also considered this question, and we've got some really convincing answers. But I argue that those answers are convincing but incomplete, because we're missing a level of institutions that are also important to understanding why some countries are rich and poor. So to do that, I'm going to try to summarize 1 or 2 weeks of my teaching in 5 or 6 slides to explain these missing middle of institutions. So as of course you know, for innovation and growth in any economy, we need people to work together and to specialize. Specialization, this is obviously the work of Adam Smith. Specialization drives productivity and growth. And in the modern economy, we have enormous amounts of specialization. So these are all the different companies that work together in order to build a plane. And this is from 2009. So there's probably even more specialization. And these are strangers. These companies usually don't know employees in other companies personally. They're from different countries. So the key is specialization amongst and across strangers. Now, of course, we've worked out over time that, and much to what upset economists when they realize this, that this doesn't happen automatically, that there's transaction costs that get in the way of this trust. So people tend to lie and cheat and steal and be lazy and check social media instead of doing their jobs, and not repay the bank unless the bank asks for the money, and so on. So there's all these transaction costs that get in the way of strangers trusting each other. So the question then becomes, is what institutions do you need to build trust amongst strangers? And I'm going to apply this later on to the shadow payment system in Africa, where you have specialization, you have relationships between mobile money firms, agents, customers interacting for the first time. So people interact. Customers in rural areas of Africa are developing relationships with agents and mobile money firms. And all these people, most of these people are strangers to each other. They face transaction costs in working together. So what institutions do you need to create that trust and drive innovation across the economy? And this is where the work of Douglas North becomes relevant. And I'm sure you've all come across his work before. The idea of institutions. We need formal and informal rules that are enforced in various ways. Economists used to ignore institutions. They used to say the price mechanism worked perfectly. Then we worked out that no, actually people lie, steal, and cheat. And so what happens is over time, countries develop institutions that create incentives to actually engage in these specialized relationships, to invest in these specialized relationships. And what they do is effective institutions lower transaction costs. So what happens is the government creates, say, courts. So instead of you and I having to build private armies to enforce contracts against each other, we delegate that job to the state and the courts and the police that the state comes up with. And that lowers our transaction costs, so we can specialize in working together rather than also building private armies, also building private courts, also building private police. Now, of course, ineffective institutions raise transaction costs and so there's going to be less innovation. So if you're in a rural area of Africa where the state has less reach, there's less courts, there's less police, you have to engage in building private substitutes, private enforcement mechanisms, and that reduces your ability to engage in innovation. Now, the question, and so Douglas North won a Nobel Prize in economics for working this out, and he changed development economics because we understood that actually countries are rich when they have institutions at lower transaction costs because that creates incentives for specialization. Countries are poor because they have institutions that raise transaction costs, so there's less specialization. Now, the question, though, is what institutions do you need in detail? We know big picture, and there's enormous numbers of studies that reveal that institutions are relevant to whether a country is rich or poor. Enormous numbers of empirical studies. But the question now has become, what institutions do you need and how do you get them? And so this is where it gets tricky, and this is where my research comes in. So we have two levels of scholarship that aim to solve this problem. One of them is the work of contract theorists. And contract theorists look at what problems arise between you and I working together at a micro level. So we need to trust each other. What problems do we need to solve at a micro level that come out of our specific deal? And they're usually things like adverse selection, like who should we work with? Moral hazard, so I've delegated a job to you and you might take excess risk and not work in my interests, and various other problems which we'll talk about. So they're specific to you and I. But of course, we know that we also need fundamental infrastructure to be able to work together. And the lower the transaction costs in solving these problems, the more we can innovate and work together. So, for example, the work of Douglas North suggests you need 3 economic institutions, and Acemoglu, Johnson and Robinson, who also won the Nobel Prize in economics for last year, supported this idea, where we need to be able to define property rights. So what can and can't you own? We need to protect property rights from the state arbitrarily stealing our stuff or one of our competitors sending in thugs to steal our computers. And we also need to enforce agreements against each other. And so over time, countries that have developed, where the state has developed ways for solving these problems on our behalf, they grow really quickly and they become very wealthy. So if you and I want to negotiate over a plot of land, we can actually go to the state-provided property registry, which actually tells us who owns what. Of course, in many regions in Africa, no one actually knows who owns land, or it's known by local communities and that's it, which raises transaction costs enormously. One of the reasons that entrepreneurs move to the UK or move to the USA is because the state protects their property rights through patent systems. The police broadly operate effectively, so people are less worried about theft. Whereas if you travel in Johannesburg, you see there's this enormous industry of private security guards because the state doesn't provide as much protection of people's property rights. What's one of the comforts of working in the UK or a country in the global north is we think if absolute worst comes to worst, we can sue each other in court. We don't need to build private armies to enforce agreements against each other. So these are economic institutions. They are, using the Northian definition of institutions, formal rules like laws and regulation, informal norms, so discussions between the regulator and citizens about how these rules are enforced, and then enforcement mechanisms, usually using courts and police. So, and in a nutshell, why are some countries rich and some countries poor? Acemoglu, Johnson and Robinson and North rounded out this picture to say the key is actually you need political institutions. So you need rules, formal rules, informal rules that create incentives for politicians to design rules for the economy that actually lower these transaction costs. So if you're in an inclusive society, an inclusive political system like the USA or the UK or the USA, you're in luck. Because political institutions are set up such that if a politician wants to get into power and remain in power, she needs support from the majority of the population. So she says, goodness, I'd better design economic institutions that create wealth for most people. Otherwise, I'll be voted out of office. So why is it that countries in the global north have these mechanisms in place? It's because politicians have worked out that they need this stuff to keep most of the population happy so they can stay in power. What happens in most countries in the global south? You have the reverse picture, broadly the reverse. Usually it's a mixture, but broadly the reverse picture, where political institutions are extractive. What that means is they create incentives for politicians to engage in corruption, to only support the work of their cronies, not the majority of the population. So basically you can get in power by repressing most people and just supporting a handful of power brokers. And what that does is that creates incentives to create macro institutions that actually raise transaction costs for most of the population. Inclusive societies, you lower transaction costs for most of the society. Extractive political institutions, you don't solve these transaction cost problems because you don't have to. You design, for example, monopolies that you own and that your cronies own. You don't bother fixing up the courts. You don't bother with patent systems that operate across society. Instead, you just might provide some of this for your cronies, but that's it. And this has been supported by, again, enormous numbers of empirical studies. And hence the Nobel Prize in Economics to North in 1993, and then Acemoglu, Johnson and Robinson in 2024. So that's our state of play. Now, what I argue, and this came to me via a lot of the advisory work I've done with the United Nations, with the World Bank, works with central banks, discussions with mobile money firms, is what happened was a lot of these organizations kept talking about central banks and how they have to always deal with central banks, and the central banks come up with regulation. And I thought, hold on, that's not captured in this model. So when the regulator comes up with regulatory specific rules, there's informal norms. They've got to go chat with the regulator all the time. These rules are enforced by regulatory sanctions or reputational damage. And I thought, where is that picture here? We're not talking about courts. We're not talking about patent systems. We're not talking about property registries. And I thought there's a missing middle of institutional analysis that I call meso institutions. Now, we've actually got some scholarship on meso institutions, which I'm happy to talk about, but it's very limited so far, usually focuses on very narrow rules. But I argue actually meso institutions are much more important than we've considered. They actually help drive the economy as a whole. And as I'll explain, they shape the trajectory of the shadow payment system. And so what I argue is that this macro institutional picture helps explain long-term innovation. So let's think about this intuitively. Do entrepreneurs want to move to a country and drive innovation over time in a country where there's no patent system, or the government can arbitrarily steal their stuff, or thugs can break into their factories? No, they're going to move to the USA or the UK or a country in the global north. Do entrepreneurs migrate to countries where the courts are totally incompetent or have got resource constraints? No, because they want these macro institutions. So they move to countries in the global north. So long term, this drives innovation. But how about specific sectors? How about the shadow payment system? We have a huge shadow payment system in Africa that I'm going to talk about. How has that worked? We have lots of innovation in Africa and other countries in the global south. How? Particularly over the short-term innovation. And I think this is very important because if you look at the economy, we have these macro institutional rules. Remember, these are for the economy as a whole. But actually, the economy is made up of sectors, individual sectors, the banking sector, the fintech sector, the insurance sector, the housing sector, the telco sector. This list goes on. And most of those rules, I will argue, those come from meso institutions, sector-specific rules. So I'm not arguing we throw North and Acemoglu and Johnson and Robinson out the door. Not at all. Their work's foundational. But to understand innovation over time, we actually need to zoom into this level as well. this level can't fully explain how innovation happens. It provides some of the foundational macro institutions you need, but you also need to solve problems here, and you also need to solve problems at this level, like coordinating industry rules. And this meso-institutional level does a lot of that. So what I will argue today is one of the key drivers of innovation in an economy, and it's one of the forces that shape the operation of the shadow payment system in Africa, is not just this level. It's not just whether political institutions exist to create incentives for politicians to design macro institutions at lower transaction costs. It's also whether quasi-political institutions exist for regulators, central banks, to work with industry to create these meso institutions that lower transaction costs. So these meso institutions are they're a real jumble. They comprise a combination of regulation, contracts, business norms, industry standards, informal norms that emerge between regulators and business groups, arbitration groups. This is a messy world here. But I argue it's crucial for creating incentives for firms to invest and to get this specialization process, because when it works well, it can lower transaction costs. And this presentation kind of veers between being depressing and optimistic. The depressing part is, if you're in a country in the global south, the evidence suggests on this model, if we just look at Acemoglu, Johnson, and Robinson, broadly, if you're in a country with extractive political institutions, you will get extractive macroeconomic institutions, and developing proper growth is extremely difficult. Doesn't matter about the technological innovations you try to launch, doesn't matter how much money comes from the World Bank or the UN. Essentially, so long as these economic institutions are weak, it's very hard to get growth. That's the depressing part. And so there's lots of research. Dead Aid was a very famous book some of you might have heard of, which basically mapped out the amount of donor aid going to Africa and says that arguably it makes it worse. And there's lots of studies that suggest that. The optimistic part of this presentation is if, and it's a big if you can create incentives for regulators and government agencies to work collaboratively with industry and co-develop these meso institutions, you might be able to lower transaction costs to get some innovation, even if your macro institutions are weak. So I'm arguing this is potentially a way forward. And I will argue that these meso institutions are a driver of the shadow payment system, and they are also a driver of innovation generally, at least in the short term. So you can get quite a lot done at this level, even if your macro institutions are weak.
Jonathan,
yes?
Can I throw you a question? So we understand that the institution is so important, not only at the political or macro level, but also in the middle level. Mm-hmm. And you talk about global SOAS in general, mm-hmm. and your assumption is without a proper developed institutional setting, then we do not see economic performance or growth. So I'm thinking about China here. Mm-hmm. So we have a lot of debate about why China. Nobody said China has developed a very good institution by the global North standard. Mm-hmm. But we have seen who has been growing the fastest. It's China. So therefore, my question is, if you assume the global SOAS is lacking of institutional arrangement so that they are the obstacles for innovation and growth. So where do you put China here?
That's a very good question. So people have raised this question with Acemoglu and Johnson directly. They've said, okay, great, you won the Nobel Prize. Tell us about China. Now, they've got a very interesting response, and they've actually written on this directly, because we have China, we have Singapore, there are other countries where arguably don't have inclusive political institutions and arguably have not created inclusive economic institutions, at least not nearly on the scale of the West. And they've got a couple of sets of answers. One of their arguments is you can actually get a base level of development with extractive political institutions. So their argument is that China has got a lot of the low-hanging fruits of growth over the last 30 or 40 years, despite having extractive political institutions. So they have a couple of chapters on this in their book, Why Nations Fail, and I would recommend that everyone reads that if you're interested in institutions. It's very long, but it's very interesting. And they chart the growth of China over the last 50 or 60 years, and they argue that the country remained largely extractive, and so it experienced quite a lot of growth. But they argue it's largely illusory growth, as in it's managed to eliminate a lot of poverty, but the next stage of growth is impossible without moving to inclusive political institutions. And they actually make the same argument with the Soviet Union. They say the Soviet Union grew spectacularly for certain periods of the 20th century, and it definitely had extractive political institutions. So by that I mean the politicians had incentives to largely govern in the interest of the minority rather than the majority, at least politically. And they said, and they argued that a similar logic with the Soviet Union will take place with China as well. That eventually it'll plateau because it doesn't have the political institutions needed to enable it to reach the next stage of development. Now, you can make a lot of critiques about that. You can look at all the supercomputers in China and the growth of artificial intelligence, and some people have raised this directly in relation to these scholars. So that is their argument. Basically, it's too early to tell. The second argument that I would make, and is actually maybe a complementary argument to them, is to say, I wonder if China has managed to grow because despite largely extractive political institutions and macroeconomic institutions, so rules for the economy as a whole, these MISO institute, the Chinese government has had an incentive to create these. So these are all the government departments in the USA. There's huge numbers of them. That China has had incentives for politicians to create somewhat inclusive MISO institutions. So they've managed to get a lot done by relying on this level without reforming this level. But I'm happy to talk more on both points, should that be of interest.
Yeah, so thank you, Jonathan. So you can continue. I think you made some points here. Please, yeah. Okay.
Great, and I'd love to talk about these topics further. Actually, China is a country that I want to explore further because I think this is what's going on. There's also work in a book called Advanced Introduction to New Institutional Economics, which talks about China and has a lot of really interesting points on this. So my argument, like I said, is that if you have inclusive, and by this I mean based on transaction cost reducing logic. So essentially, if you can establish at this level institutions that create incentives for these government departments and the central bank to work with industry in order to operate through economic logic, meaning lower transaction costs, then you can get a lot done because these MISO institutions actually do some of this and they actually solve problems at this level and at this level. So that's what I'm going to argue today. But if at this level you have institutions for these government departments to actually favor one group over another and be extractive, for example, bank lobbying, favoring banks over fintech firms, then actually this will increase transaction costs and you'll have less innovation in the economy. So applying this to the shadow payment system in Africa, what I'm going to argue today is that one of the reasons this sector has grown is generally over time, governments have established institutions and incentives at this level where regulators in most countries have lowered transaction costs for mobile money firms so they can compete against banks. And so that's allowed the shadow payment system like mobile money and other services to take off. But in some countries, there's been blockages. And most blockages have come at this level. MISO institutions have favored banks over mobile money firms. And that's happened because banks have lobbied. So the action takes place at this level primarily. So North, Acemoglu and Johnson, the action takes place at this level only. I argue that the action takes place at this level and at this level. Now, you might say, why care? Why bother? Well, because I would argue that to better understand innovation and economic change over time, we need to focus at this level as well. And I want to emphasize that I'm not just talking about regulatory rules. Douglas North was always at pains to say, look, I'm not just talking about formal rules. I'm talking about formal rules, informal norms working together to lower transaction costs. And even more fundamentally, it's how these rules evolve over time. So this is really important. So what I'll be mapping out today is how regulators in some countries created an implicit contract with mobile money firms, banks, other organizations. So essentially meaning you can operate in our market, but only on certain grounds, and we can enforce rules against you, much like a contract. And so the shape of the shadow payment system and the shape and trajectory of innovation over time is how that implicit contract evolves over time. Do they work together and design rules and enforce them in fuzzy, interesting ways, in ways that lower transaction costs for mobile money firms? If so, mobile money firms and the shadow payment system can flourish. Or does this system evolve over time in ways that raise transaction costs for mobile money firms and mean they can't compete against banks, in which case the shadow payment system doesn't grow that much? So that's the fundamental point. It's how these MISO institutions, these fuzzy rules, some formal rules, some informal norms, how they evolve over time. And I'll argue this can help explain the growth of the shadow payment system. So the rather dramatic title of this talk, MISO institutional change and the future of the shadow payment system over time, what I'm arguing is that we can understand what's created the shadow payment system in Africa and how it's going to evolve in the future, not by focusing on the rules per se, not even by focusing on the technology, because new institutional economics has established that technology is actually secondary to whether countries innovate. We can understand how this system's evolved and how it's going to evolve in the future by focusing on institutions. Some of it at this level, but primarily at this level. So that's my first argument, that MISO institutions are the missing middle of institutional analysis. Now I'm going to apply MISO institutions to understand the trajectory of the shadow payment system. So for that, I need to explain what I mean by the shadow payment system. So before going down that path, I want to pause to underscore the importance of the payment system in the global economy. I actually think it's really interesting. So I actually came across the mobile money and the payment system in 2012 when I was working on an internship with the United Nations in Timor-Leste, a small country near Australia, and it's revealed itself to me over time how unbelievably important the payment system is in the global economy. This is the amount of money that goes through the payment system every year. That's a lot of zeros. And it's interesting because finance normally focuses on credit or insurance, but payments are enormously important. So let me ask you this: what would happen if the global payment system collapsed tomorrow? Utter chaos. Utter chaos. Payment system's extraordinarily important to the economy. Every day, all of us, we make payments. Now, what's happened in recent years is we've seen the rise of the shadow payment system. So personally, I was shocked. I'd done a whole bunch of work in Malawi, and then moved to the USA. And I couldn't believe it when my landlord in the USA said, to pay me, you've got to provide a check. And I'd just been in Malawi where I hadn't seen cash for 3 months. This is in 2017. And I said to him, look, can't you just give me your bank details and I'll just send the money to you? And he said, we're a small company. We don't have that sort of infrastructure. And I thought, what infrastructure? A bank account? How is that a lot of infrastructure? It's a lot less than using a check, which will take 3 days to process. And when I first arrived in the USA, bank payments would take 3 days. And I just come from Africa where mobile money transfers would take 2 seconds. So over time, firms have worked this out and created faster ways to make payments because the bank payment system has just been too slow. Now, what's happened is this is largely called the shadow payment system. Firms provide the payment functions of banks where you can store and transfer money through these services, but they're not subject to bank regulation. So some of you might have heard of Venmo in the USA. I think Wise is used more commonly in the in the UK, where you can deposit, store, transfer, and withdraw money just like a bank account, but the service is provided by a firm that is not subject to bank regulation. Now, the benefit is these firms can often process payments much faster than banks. They've invested in the technology. They're not subject to bank regulation, which means their regulatory costs are much lower, so that frees them up to innovate. But of course, the trade-off is the beauty and the cost is they're not subject to bank regulation, which creates a problem. What happens if these firms collapse? I used to be a lawyer, so I'd love to talk about law for the next 20 minutes, but I'm not going to. Basically, if a bank collapses, we have all sorts of interesting tools we can use to deal with it, to stop it going into a country's regular bankruptcy proceedings. We can bail it out. We can use deposit insurance. We can provide all sorts of interesting tools to keep it alive or to transfer deposits to someone else. Mobile money firms and other members of the shadow payment system are not subject to bank regulation, which means we don't have the ability to provide those tools to those firms, which means customers' funds and the economy are exposed to potentially serious risks. So that's that key gap, which I'm going to talk about today. What do you do? And so the shadow payment system is really important in Africa. There's a whole bunch of interesting services that have come out, but the most foundational, without doubt, is mobile money. So mobile money, essentially, think about an account where you can deposit, store, and transfer money, just like a bank deposit, but it's provided by a mobile phone company, not a bank. And there you have mobile money. Enormously important, 1.1 billion accounts in Africa, 1.1 trillion in transactions. This is from GSMA, which is an industry group. Now, the benefits are that mobile money is the first major payment service that's been able to serve the enormous numbers of people in Africa who don't have access to bank accounts. And there's been a lot of donor interest in this service because if people don't have bank accounts, they tend to have to store and deposit and transfer money in cash. And you can imagine how hard that makes it to move out of poverty. People can steal your cash very easily. If you want to send money to the other side of the country, previously people had to entrust money in specially marked envelopes and give them to bus drivers and say, when you go to my mum's village on the other side of the country, can you drop this cash off to her? You can imagine all the problems with that. Mobile money has operated in ways that millions and millions of people have been able to transition into using digital payments. Particularly through these agents, which I'm going to talk about. So instead of depositing and withdraw money from branches or using ATMs, which you might use if you're a bank, you can use one of these agents, which are corner stores and petrol stations, which operate through contracts that they have with mobile money firms. So remember the two differences. Provides the same deposit, storage, withdrawal, and transfer services as a bank deposit, but one, the account is provided by a mobile phone company or another non-bank. And two, you don't deposit and withdraw money from branches or ATMs. You use these agents. So what is the problem? What is the issue? What is the problem? Why have I bothered explaining this idea of meso-institutional change and then trying to tie it to the shadow payment system with a particular focus on mobile money? Because what I'm going to argue is that meso-institutions are key to lowering transaction costs in providing mobile money, particularly lowering transaction costs, which create incentives for mobile money firms, for agents to create substitutes for bank regulation. So this system only works if agents and customers and can trust the mobile money firm. To do that, they've got to create substitutes for this regulation. Otherwise, the regulator will never allow it to take off, or there'll be a failure and people won't trust it. And so the key is, how do MISO institutional change over time create incentives for these substitutes to emerge? What do I mean about these substitutes? So the beauty of mobile money is that what it does what we might consider unbundling banking. So if you look at a bank performs all bank functions. You can deposit and withdraw money, so access liquidity. You can store it. The bank invests money through credit creation, and you can transfer that money to other people. Now, the beauty of this system is it's highly, highly regulated, so we can trust it. But although banks still fail, but the cost is it's incredibly difficult to provide. It's incredibly costly to provide all these functions. You've got to have cash vaults. You've got to have human resource policies. You've got to have corporate structures. You've got to be able to comply with regulation, which makes it almost impossible. The transaction costs are way too high in order to provide liquidity and other services to, say, this rural woman in rural Kenya. So what mobile money does is unbundle these functions. And this is the specialization that Adam Smith would talk about. There's actually specialization going on here, where Safaricom, the world famous mobile money sector in Kenya, Safaricom just transfers money. It never actually stores money, never invests money. Instead, all money from a mobile money scheme actually sits in trust accounts in a bank. And Safaricom just facilitates transfers between people's accounts. Okay, so she says, great, I want to be able to transfer money to other people. And Safaricom says, right, I've got a challenge, because all the money is actually sitting in trust accounts in banks. How do I get it to you? So you can take cash and deposit it into electronic money and actually withdraw electronic money back into cash. This is extremely important because the overwhelming majority of payment transactions in Africa take place in cash. So people want to be able to put some money in digital form, but they also need to be able to convert it back into cash easily for other payment transactions that they have. So what happens? What happens is Safaricom set up a system where you have an aggregator. So this is a retail outlet, a petrol station chain, a supermarket chain, and they go to the bank and hand over cash, let's say £100 of cash or money from their bank account. And in exchange, the bank transfers £100 of electronic money to the aggregator. So the aggregator's now got, say, £100 of electronic money. Maybe she also invests, say, £50 worth of cash into this system. And Safaricom has a contract with the aggregator and says, your job is to ensure that all these agents, which are your branches, that they have sufficient reserves of electronic money and cash so that when a customer comes along, she can deposit and withdraw money upon demand. So what the aggregator does is send money to agents so that they've got enough reserves of electronic money and cash. So she comes along and, say, deposits 20 pounds of cash. She wants 20 pounds of electronic money. The agent says, right, I need 20 pounds worth of electronic money. And there's a communication and exchange that enables these agents to have enough reserves of electronic money at cash at all times. This is the goal. So these agents actually find really creative ways to rebalance their reserves of electronic money or cash. Sometimes they'll go to their aggregator. Sometimes they'll trade with the agent down the street. So maybe there's another agent just here, and the agent says, I need 30 pounds worth of cash. So he goes down the street to his friend and says, here's 30 pounds of electronic money. I need 30 pounds of cash. He gets the cash and then provides it to the customer. So this is actually a marketplace. This actually becomes a marketplace. So what happens? Here we have banks, and this is the beauty. Adam Smith would love this, because the beauty, of course, is we have these banks which specialize in providing larger liquidity needs to wealthy people. They perform all these functions. They specialize in vaults and investment mechanisms and so on. Then this system, I call it a bridge system, where it's a marketplace of agents and aggregators and Safaricom and banks and informal trading and transfers and motorbike drivers being paid to transfer money. This system's incredibly complex. It's a marketplace that combines to provide the same functions of banks, but it does it in these very intricate ways, and ultimately can provide these smaller liquidity needs for underbanked people who've got little or no access to formal financial services. So we have this bundled system, which supports large liquidity needs, and this unbundled system. And so this is the beauty of the shadow payment system. If you get the institutions right, you can create this bridging system that unbundles the banking model, and it essentially carves out micro storage. So these agents store very small amounts of money. They transfer very small amounts of liquidity, sort of like a micro version of banking. This is a larger version of banking. And then, of course, this is the full scale of banking. Now, the central challenge is, how do you make it reliable? As in, how do you build trust in this system? Remember the diagram I had about you have specialization, transaction costs, and you need institutions. So what happens is these models create transaction costs. There's all sorts of opportunities for lying and cheating and screwing up and messing up the system, being human beings, basically. Now, the beauty of banks is we have this very elaborate set of institutions. We have corporate law, unfair dismissal laws that protect employees. We have MESO institutions of banks. So remember, MESO institutions are formal rules, informal laws, informal enforcement mechanisms for sectors of the economy. We have the MESO institution of banking here that ensures that banks are run sustainably. The question here is, in this sector, you don't have a lot of this stuff. A lot of the corporate law protections are stripped away. These are independent contractors. They're not protected by corporate law, unfair dismissal rules. You don't have bank regulation applying to this sector. So if it's going to be trustworthy, there's all these transaction costs that we've got to minimize. How do we do that? We can't rely on the state to provide these mechanisms to lower transaction costs. We need to create incentives at the MESO institutional level. That's the key issue to making the shadow payment system trustworthy and grow over time. So how does this apply? I've talked about MESO institutions. I've talked about this shadow payment system with a particular focus on mobile money. I hope you're still with me. I know it's all quite technical thus far. So this leads to the question.
Honestly, sure. Can I make one thing clearer? I ask you. So who owns this M-Pesa?
Who owns what in relation to M-Pesa?
Yeah, who owns this company? Let's say, who owns this little mini bank or agent?
Yeah. Oh,
it has to be Safaricom, right?
No, well, that's actually the beauty of the system. And thank you for the question. These are actually independent contractors. These are actually separate companies to Safaricom. So these aggregators are, say, petrol station chains, and they've got, say, 50 branches across Kenya. These aggregators actually own their outlets. Safaricom doesn't own them. So what I didn't want to give the full details because I thought the slide was going to get too messy, but there's actually two models here. One of them is when you have an aggregator that owns a whole bunch of outlets, branches, and these branches also become agents. Mm-hmm. Another model is when you have an aggregator that actually signs up corner stores, kiosks, fruit market chains through contracts. So you can imagine, if we think about this model here, you have an aggregator, let's just say with 50 branches of its petrol station chains, and then the aggregator wants to expand but it doesn't have any more branches left. So it will approach these corner stores and petrol stations and say, do you want to be an agent for M-Pesa? And then Safaricom provides a template contract that the aggregator uses with these independent contractors. So, but these all operate through contracts. These are all independent contractors, except for the aggregator and its branches.
Yeah. Okay, thank you. Yeah.
Okay.
Thank you.
Thank you. Clearly, I need to make that clearer when I explain this. They're independent contractors. And so you can see that that's the beauty and the cost of the system. The beauty is because they're not branches of Safaricom, which means they're not subject to corporate law and unfair dismissal laws, which frees up all these different organizations to innovate. And also because Safaricom doesn't handle money directly, it's not subject to bank regulation, which also frees up innovation, frees up space to innovate and work out how to support the liquidity needs of the unbanked. But the cost is it means all these transaction costs that are normally addressed by these sets of rules aren't addressed. And so the question becomes, how do you create incentives to create substitutes to ensure that this system can function sustainably?
That's really good. But there is a sub-market here. There is a subcontract here, a franchise. So there's something extra. Yeah. So we can go ahead. Yeah. But that's really interesting.
Yeah, exactly. So there are these very intricate contracts. And so some people look at mobile money or these innovations and they say this is happening in an institutional void. And the only thing interesting going on here is technology. And I think that's wrong. Because once you zoom in and study, and I've studied these contracts, they're actually extremely long and extremely complex. So the project aims to understand how do you support that complexity. And I argue it's at the meso institutional level, not at the macro institutional level. So that leads to the puzzle. And the puzzle is, why are there so many more mobile money agents than bank branches and ATMs in most countries? So in most countries around the world, and this is data, all this research is very much a work in progress. Don't tell my publisher because the book's due in March, but it's still a work in progress. I'm still pulling it together. But essentially, in most countries where mobile money operates, and it operates in 99 countries around the world, generally you have many more agents versus bank infrastructure, 10 times or more in these countries. 5 to 10 times more in these countries, outnumber banks in these countries. But so the majority of places where mobile money operates, it vastly outstrips banks, but not entirely. In some areas, it's actually the other way around. And why is that? There's generally an unmet demand in most countries in the global south, or there has been until recently. Yet, and banks existed and they had ATMs. Most countries, they had a 150-year head start on mobile money. But in some countries, mobile money has built vast numbers of agent networks. And what I will argue, there's many reasons why, but what I will argue is it's actually different choices at the meso institutional level. That actually what happens is meso institutions have evolved in some countries to favor mobile money firms, or at least to not discriminate against them. And that's what's created massive innovation. And in other areas, meso institutions have evolved to protect banks, and that's inhibited innovation. So they provide the same functions. Now, macro institutions can't explain this picture. So you remember my beautiful triangle from earlier, where you had contracts here and macro institutions here. And the work of North, Acemoglu, Johnson and Robinson say the key is whether there's political institutions creating incentives for politicians to create those three main macroeconomic institutions: defining property rights, enforcing them, and protecting against theft for the sector, for the economy as a whole. Now, that can't explain the full story, because in all of these countries, mobile money firms and banks are subject to the same macro institutions. So in Kenya, banks and mobile money firms are subject to the same courts, the same police, the same politicians. Yet mobile money has flourished so much more than banking. So macro institutions can't be the full story. So the answer, and most of the innovation in agent networks, is taking place in rural areas where there's no meaningful reach of macro institutions anyway. Those of you who've traveled in the global south, particularly in Africa, will know that once you leave major cities where most of these agents are located, you don't see courts, you don't see police, you don't see these organs of the state that operate these macro institutions. There's something more going on. And what more is going on is meso institutional change has created incentives to create those substitute governance structures. So what I argue is that in these countries, MISO institutions have evolved in ways that have created incentives for mobile money firms and agents and central banks to create substitute for bank regulation, enough trust that it takes off. Whereas when MISO institutions evolve in ways that favor banks, they raise transaction costs on mobile money firms, and mobile money firms don't have incentives to make substitutes, and so the mobile money sector doesn't take off. Now, why does this apply to my dramatic title of the future of the shadow payment system? Because this is what's going to shape the future of the shadow payment system. Whether there's more evolution and growth or whether it stagnates, it's not going to be the regulatory rules per se. It's not even going to be the MISO institutions per se. It's going to be whether there are political incentives to allow the evolution of MISO institutions over time that lower transaction costs for the shadow payment system. That's what's going to determine whether the system keeps evolving. So what do I mean by that? So why do I keep talking about these MISO institutions? What I'm going to try to do is pull it together now in the next couple of slides. Oh, and I'm conscious that I've actually talked way over time. So I will just speed up a little bit. That what's happening is governments are actually under pressure to build more inclusive societies. So these are the number of countries that have signed up for the Alliance for Financial Inclusion, which is a big collection of central banks, a big organization housed in Kuala Lumpur, and enormous amounts of donor funding. And what's essentially happened is they put pressure on governments to enable more people to access financial services, to move and support the underbanked. And so governments are under pressure, the elites are under pressure to actually sign up to this system because that's how they can get more donor funding. And they actually look bad to their neighbors if enormous numbers of people are still unbanked. And eventually, people in their home country might work this out and call for radical change to how society operates. The elites don't want that. So they've signed up for this system. And so they say, how do I build more inclusive societies? They don't want to relinquish power. What I mean by that is they don't want to reform the macro institutions. They don't want to create free and fair elections or enable the courts to pass judgments against them or empower the police to kick them out of office if they don't leave office when they're voted out. So what they do is they've got political incentives to actually create those MISO institutions that I talked about. So what they do is they say, right, I'm going to delegate the job of building a more inclusive society to central banks and regulatory bodies. And what they're going to do is generally we've realized that mobile money is a great tool for financial inclusion. So most countries have allowed mobile money firms to compete with banks. Some of them haven't because they still favor banks through, say, bank lobbying. But this is what's going on. The reason we're seeing the shadow payment system and this massive agent network, Safaricom alone has 220,000 agents, is because of what's going on at that MISO level. So what happens is when there's incentives to allow these MISO institutions to emerge, the MISO institutions have evolved to lower transaction costs. And I should have had my triangles here, but I think you might remember. There's political incentives here, creating incentives at this MISO institutional level that have lowered transaction costs for mobile money firms in most countries, hence this rapid growth over time. So if you have an economic approach, mobile money dominates. So if these central banks and government departments are operating on strict economic logic, then they lower transaction costs for everybody and mobile money firms can compete. If there's a bank preference approach, so supporting the elites, then banks tend to dominate and mobile money doesn't take off. So what I'm going to do now is just talk briefly about these agent networks. So just to give you, and I'll speed this up. I hope it's okay. I'll just be another 5 or 6 minutes about just zooming in to understand how this applies at the micro level. And this is part of my claim that actually we need to get beyond the hype of the shadow payment system and the hype of innovation in Africa as a whole. It's not the technology per se. It's actually zooming in at the micro level to understand how to lower transaction costs on firms in order to encourage and create incentives for them to innovate. And we've seen this with agent networks, and I'm going to just talk briefly about that now. So remember, we have this intricate system. Safaricom has 200,000 agents alone. Ghana, where I've done some research, has 420,000 agents. These are absolutely foundational because people have got to be able to deposit and withdraw money upon demand. They've got to deposit cash and be able to get it out again upon demand. So these systems are enormously complex. But you have a question of how to create incentives to build this substitute system. And if you don't create those incentives, mobile money doesn't take off. Firms just say, I'm not going to invest. Agents say, I'm not going to invest. So remember Adam Smith, there's potential for specialization, there's potential for growth, but there's transaction costs. You will only get innovation if you can find ways to lower those transaction costs. And there's three, what I will argue is that this doesn't take place through macro institutions. They don't create incentives on mobile money firms and agents to lower these transaction costs because they're too broad. So what do I mean by that? Politicians pass legislation for the economy as a whole. As you all know, technology happens way faster than the democratic process. You can't wait for the government to legislate on what to do about Uber. The rules for Uber emerged at this meso-institutional level, and macro institutions like the political system caught up later on. How are you going to enforce contracts? Remember, one of those three macro institutions is enforcing contracts. How can people enforce contracts when you're talking about very small, very poor agents in rural areas of Kenya? These macro institutions are just too slow, or they're unavailable for most of the population. So what happens is most of the innovation takes place through this meso-institutional level. This is where the action is. And I'll just briefly provide examples of three ways in which meso-institutions created incentives for innovation. One of them is what's called residual control rights. And just very briefly, what this means is those of you who've studied contract theory will know that when people work together, they have a contract that says, okay, Google will do A, B, and C, and NASA will do X, Y, and Z, but all contracts have gaps. Things are going to happen in the future, and we don't know what they're going to be. Google might decide, actually, I don't want to do this innovation anymore. NASA might say, Trump has crashed half our funding, so we've actually got to scale down our investment in this project. So there's going to be gaps. So there's a question of who should have residual control rights. What this means is when there is a gap in the contract, when there's something happens that is not documented in the contract, who should decide what to do? Should Google have the rights on the contract to say, look, if something random happens, we've got the rights to terminate the contract, or we can create new rules for how we're going to work together? Or should that be NASA? Doesn't sound like much, but this is actually extremely important. Macro institutions can't solve this problem because they're too broad. Legislation, court cases, they're usually too broad to resolve these issues. These are micro-level issues between firms. Oliver Hart, who won the Nobel Prize in Economics for Contract Theory, has worked out that the party making the biggest investment must have these residual control rights because they're the one that have got to protect themselves because they're doing most of the work. So there's a question, should Safaricom have these residual control rights, or should the bank in which customers' funds stored, should they have residual control rights? And this gets to this problem I talked about. Under economic logic, Safaricom would have the control rights. That's going to lower transaction costs and allow innovation in this system and the shadow payment system and mobile money to take off. If the bank lobbies hard enough, the meso institutions might lower transaction costs for them, and they have these residual control rights, and that will result in stagnation. That's what we forecast. What we saw in mobile money is macro institutions didn't resolve this problem. Believe it or not, there were no court cases in mobile money from when it launched till 2017. So there were hundreds and thousands of agents without any reference to the macro institutions that Douglas North, Johnson, Acemoglu, and Robertson talked about. Instead, these problems were solved at the meso-institutional level. So what happened was the Central Bank of Kenya sent a letter of no objection to Safaricom saying, so long as you provide adequate protection of customers' funds, then you can essentially do what you want in relation to these residual control rights. So it was allocated at the MISO level. So these are the informal rules that I've explained underpin MISO institutions. What happened? This is the governor of the central bank providing this letter of no objection. You had enormous growth in the number of agents and enormous innovation over time. There was enormous innovation because Safaricom had these residual control rights. And you might say, does this apply to other countries? Because I've heard that Safaricom is a near monopolist in the mobile money sector. This does. If you look at Ghana, originally the Bank of Ghana said that banks have residual control rights. So between 2009 and 2012, almost no agents. Then the Bank of Ghana started discussions with banks and mobile money firms, and news got out that mobile money firms could have residual control rights, and growth in agent networks started. And then there was a change in MISO institutions, the formal rules, and there was massive growth of agents. So these residual control rights are extremely important. This is one of the key functions of MISO institutions and how they support innovation. On the other hand, if MISO institutions provide residual control rights to banks, then you have stagnation. So in South Africa, mobile money firms just couldn't take off. And one of the reasons is because they said regulation is too extensive and banks have too many of these residual control rights. The second one, just quickly, I will talk about is how do you ensure, all right, Safaricom's got all these residual control rights, but how do you ensure they actually don't mistreat agents? How do you ensure that they don't actually say, right, I've got all the rights under the contract, I can terminate contracts whenever I want. You have these agents who've invested time, money, and resources to become agents. How do you ensure that Safaricom doesn't sack its agents arbitrarily and cause their loss? And you might say, well, you can leave the market to solve this problem, but this was a real issue. These are low-income communities where loss of a mobile money sector, of a mobile money access to M-Pesa could be a major problem. Again, too broad. Macro institutions can't solve this problem. These are specific governance problems at this micro level. So how were they solved? They were solved at this MISO institutional level. The lowered transaction costs to enable trust to grow in this system. How? Well, what happened over time, remember, no court cases until 2017. That was when the first court case, so that's when macro institutions became relevant. But even then, only one court case. And by then, there were already hundreds of thousands of agents. So what happened? Over time, at the MISO institutional level, the Central Bank of Kenya closely monitored how Safaricom dealt with its agents, ensured that it didn't mistreat them. Also, over time, the Competition Authority of Kenya told Safaricom, you can't have exclusive contracts with agents anymore. So what this is designed to do is create incentives for Safaricom to treat its agents well, because if it treated agents badly, they would go and work with other mobile money firms. Initially, agents were locked into long-term contracts with Safaricom. And then monitoring continued. So the action continued to take place at this level. The last point I'll talk about is how to address potential collapse of the whole system. So what happens if there's an operational failure at Safaricom and these agent networks suddenly collapse? They can't deposit and store money. Remember how I talked about the enormous size of payment systems? What happens if 220,000 agents, there's a mass operational failure? And there has been short-term outages of mobile money in countries, and there's been major problems because people can't deposit and store money and transfer money. Again, the macro institutions are too broad. Trying to work out how to address this negative externality, rules that stop that can address this problem are too broad at the macro institutional level. So what happened? This problem was solved at the MISO institutional level. The Central Bank of Kenya monitored the operating system that Safaricom used. These are the informal norms. And then eventually more formal rules were introduced that required the Central Bank of Kenya, required Safaricom to use backup plans if there's arbitration, if there's operational failure. So very quickly, where does this take us? What next for the shadow payment system in Africa? Remember, this is the model that I've been arguing today. This is the main driver of innovation, including for the shadow payment system. This is an important driver of innovation. The key is, are there incentives at this level that create these economic institutions? So solving residual control rights, addressing negative externalities, enforcing agreements. So much action takes place here. Why care? Well, let's think big picture. We don't actually know how to help countries move to more inclusive political institutions and thus grow more quickly. Johnson, North, Acemoglu, Robinson, they've all stated this in their work. So that's the depressing part again. The depressing part that I would add is we don't even know how to create incentives for government departments, regulators to work with industry, monitor, have these norms that lower transaction costs at this level. But we can at least understand some of the trade-offs. So, for example, if Kenya still has 49% of its population in poverty, rather than strengthening courts, which will take forever and arguably won't work, another option is how can we tweak MISO institutions at this level to try to stimulate more innovation and growth? And what we'll see for the future of the shadow payment system is decisions made at this level. To what extent do political actors at this level create MISO institutions that lower transaction costs, in which case we'll see more innovation, or raise transaction costs? And on a last optimistic note, this might not be able to transform economies over time, but we can get a lot done through MISO institutional reform. So we should study them further. Thank you so much.
Thank you, Jonathan. And I'm very impressed actually by your presentation. I think you followed a very close structure of developing your presentation, and you have a very clear theoretical foundation. You will have a case to apply to, and then you draw some conclusions. So I think I'm sure my colleagues here will find it the same. So it's a very, very, let's say, intriguing presentation. Thank you very much. So before I kick off the discussion, I think, so probably I'm very impressed by this development actually in general. So I'm asking about a couple of questions. I'm asking let's say two very important questions. One is, what is the relationship between this informal financial sector and formal financial system? Do you still need to develop a formal financial system so that in the longer run, what you have been talking about is sustainable? Because this is all about, to me, it's all informal financing. So do we still have that kind of connection? And I can add more thing to this point, because think about why is this mobile money so developed in Kenya or some other African countries? So what happened, and why are they so popular in rural areas, in the area that they even do not have constant supply of electricity, but they still have a mobile phone? So that's my question. And then that leads to the real economy. So this is also depends on the structure of the real economy. So if the real economy contains a lot of very big scale corporations, very big firms, then probably this type of things will not work that efficiently. So you need much more. So that's why we see many of this type of, mobile money, even at the firm level, they already use the mobile money to do the payment things. So that's my basically question. And my second question is more like, you said that this is good for innovation because you created a career area that is a combination between formal and informal, and just to keep one eye closed and to let it go, because this is good for inclusion. But to me, this is the innovation in institutions. So you do not really have that institution from where you start with, from the conventional institutional theory. So in fact, you started from the bottom. and then you created some loopholes or gaps where a market niche, so that provide the opportunity to have a kind of innovation in institutional setting up, and which is fascinating to me. So I will leave those two comments or questions to you, and if you want to respond, you can. But let me open the floor to the audience, to colleagues, and see whether we have more questions.
So should I answer those questions now, or take a few questions at once?
Yeah, do we have more questions? Maybe I can pick up some questions and then you can respond probably.
Sure. Thank you.
So Martin, good to see you.
Thank you. Can you hear me?
Yes, clear. We can hear you clearly. Yeah.
Okay. My question is related to the first question you asked, and that is that this isn't it the case that this system can only work because M-Pesa has to deposit the equivalent of its mobile money in a regulated bank, in an escrow account. In other words, it can't work without a regulated banking system. M-Pesa cannot be allowed to create electronic money out of nothing.
Okay, is that only one question, right, Martin?
Yes.
Yeah.
Sure.
Okay, thank you, Martin. And do we have any other questions? Maybe we can collect one more, and before Jonathan can respond. But I think, Jonathan, you can probably respond, and then during the process, maybe we can have more questions. Yeah. Please.
Sure. So thank you. So thank you for the questions. So in terms of relationship between the formal and the informal, to me, that's one of the most fascinating components of this work, of this project, of this service. And not just M-Pesa in Kenya, but mobile money in the other 99 countries. That what it does is it merges the very formal legal world of banks with the very, very informal world that she would tend to live in, with cash-based systems, with very flexible friendship-based lending products. So this is a prism that somehow enables this very formal world to connect with this very informal world. So what tends to happen is for the users, and this goes I think to a couple of your questions, is that it doesn't actually try to replace everything she does, which is the beauty of the system. So, for example, she can still make most of her transactions in cash, and that's actually what the data reveals. Most users still, particularly in rural areas, still make their transactions in cash. But what they do is if they use mobile money for remote payments. So she says, right, I want to buy some bread over here. I want to lend money to my daughter over here. But I now want to send money to my daughter in Nairobi. So then I go to the agent and I convert that money into electronic. I convert that cash into electronic money, send that money to her instantaneously. And then maybe later on, she sends some money back to me when she gets paid. I go to the agent, I convert that money back into cash that I can continue to use in my largely informal world. So it complements and slots into this largely informal world that she uses. And that's also the beauty of the agents, because most of them aren't formal office blocks like, say, Safaricom. So they operate as a bridge between this formal world and this informal world of being highly flexible. So, for example, she says, look, I need to get cash in and out of my account at all times, or almost all the time. I might need cash at short notice at any time, often. One of the reasons that she doesn't want to use banks is they're way too far away. And even if she's in an area where banks are nearby, they are only open between 9 and 4, and there's big queues. Whereas the agent, because he runs a retail outlet on the side that's open 18 hours a day, she's got a much better chance of being able to deposit and withdraw money. So it's a very useful way of complementing. She continues to use her informal services for most of her transactions, but uses these more formal system when she wants to make payments over space and over non-trivial space. So the reason it's so popular is largely because it enables remote payments. In terms of the real economy, I would suggest that one of the reasons we've seen the shadow payment system grow, even in countries where most people have got bank accounts, is because the bank-based payment system has just been too slow. They haven't invested in the technology needed to process instant payments. So as I mentioned, when I first got here to Boston in 2018, a bank payment from my account to another person's bank account would take 3 days. Now, M-Pesa was launched in 2007, and it already had instantaneous payments. In the USA, the hotbed of capitalism, it took 3 days. So the reason you have Venmo, and to the extent you have similar services in the UK, is because firms work this out and have provided a faster way to make payments. Now, I wouldn't invest in Venmo for a bunch of reasons, one of them being that banks, at least in the USA, have worked this out, and they now have the Zelle payment system, which is instantaneous. So eventually, why will people have Venmo accounts when it's just and a bank account? My guess is eventually people will just transition back into bank deposits. But if you don't have access to banks, which most of these communities don't, then the M-Pesa system or other mobile money services are ideal. In terms of the evolution, I also would argue that this is a story of institutional evolution. And that's what I tried to argue in my presentation, is to say that it's meso-institutional evolution over time. That's what drives the growth of these shadow payment systems. It's not the technology per se. It's not even the regulation per se. It's how the formal rules, the informal norms, the enforcement mechanisms, how they evolve over time, and whether they evolve in ways that lower transaction costs for firms and agents, or whether they raise transaction costs. That will determine what happens. So in the case of Kenya and a bunch of other countries, there was an evolution on all levels, except for the macro institutions. So there was an evolution in contracts, there was an evolution in meso institutions, there was an evolution in these informal norms, and over time, that evolution lowered transaction costs. That's why it took off. If it raised transaction costs, it would have stagnated. So to understand evolution over time and innovation, how countries innovate and why some countries are rich and some countries are poor, Douglas North told us that we need to look at macro-institutional evolution over time. I'm arguing we also need to look at meso-institutional evolution over time. And I hope that this case study demonstrates that point. In terms of the importance of banks, like Martin asked, banks are critically important. In fact, some people used to call this branchless banking, and that's wrong, because banks are actually very important. So all the money must be backed by funds in trust accounts in banks. So banks are foundational. So the question then becomes, how do you get money from banks to the customers? And that's where the agents operate. So banks have got a delicate balancing act here. If there's too many bank branches, then mobile money can't take off because people don't need them. If there's too few bank branches, it's really hard for this agent network to grow because the agents and the aggregators have to travel too far to get more cash from the banking sector. So the only reason you need quite a few banks available for these systems to grow to lower transaction costs that these aggregators and agents face, but not too many, because you have too many banks, you don't have enough market demand for these agent networks and for mobile money as a whole.
Thank you very much. But imagine if I am a farmer, I probably prefer to have a proper bank account. But if I cannot, I then use mobile money. So do you think this is still the case in, let's say, the next 5 or 10 years? So To me, it's all about the lack of development of formal financial sector, the lack of access to rural people, to the formal financial sector. And that's why you see the popularity of using this informal thing. But, you mentioned correctly, at the end of the day, it is out of the regulation. So a lot of shadow activities are going on. So therefore, in the future, how to sustain this, and probably we still need to go back to the formal, to develop formal financial sector. But this is good. This is good in between the transition.
Yeah.
But, Johnson, I have one question. Actually, I have one observation. I do not have that many experience in the rural area in China, but I know that they use mobile money, but they do not need that little agent. I do not know how to explain this. So why do you need that little agent? Is that because of the lack of development of the telecommunication system, or some other things? Maybe it's the infrastructure things, probably. But just the one observation.
Yeah. Thank you for both questions. So I know I've talked a lot about rural areas, but actually, a lot of the original M-Pesa users and still a lot of the current M-Pesa users are actually in cities as well. Because the question is not so much poor rural per se; it's actually, can you process very small transactions? Do you find it profitable? So the problem with banks is they're so costly to run that small deposits and withdrawals, whether it's from people in cities or people in rural areas, tend to be unprofitable for banks, but particularly rural, because in rural, you've got to go out there and build branches and gather information on liquidity needs. So M-Pesa emerged as a way to specialize in performing those smaller transactions. So in terms of, if I'm a farmer, would I prefer banks or M-Pesa or another mobile money service? I think that's very complicated, because I think a lot of particularly well-educated members of the economy probably have a hazy understanding that banks are heavily regulated and mobile money firms less so. And I think banks try to show off how flashy and special and profitable they are to make their depositors feel more comfortable about entrusting their money with them. So they have these very glitzy, glamorous offices, and we hear news about the government regulator regulating banks. So I think that, whereas if you look at these systems, they don't have the bells and whistles you have of a bank branch. So possibly a farmer would ideally use a bank, but some people argue it's actually the other way around, that a lot of particularly rural communities have never dealt with banks before and so don't actually trust them very well. Or sometimes mobile money can operate in countries where the banks aren't run very well, and so people actually might trust mobile money even more. But either way, your point stands that to get, and this raises another, and this has given me maybe an idea for what the final chapter will look like, is the key. One of the key issues is, do we want the shadow payment system to complement the banking sector or substitute it? So when mobile money really works, it's when MISO institutions create space for the evolution of institutions and contracts that allow mobile money firms to complement the banking sector. So what do I mean by that? Safaricom doesn't invest funds. You don't get interest payments from funds stored in your M-Pesa account. It's just trying to provide a way to transfer. So it's stolen a little bit of what banks do, and then it just takes money from banks and provides them to customers. In other countries, what's happened is rural MISO institutions have evolved to allow mobile money firms to more substitute for banks. So, for example, in Ghana, customers can get interest payments on their mobile money accounts, something that traditionally only banks have been able to provide. In Nigeria, mobile money funds are protected by a form of deposit insurance, pass-through deposit insurance. Traditionally, that's only been the exclusive right of banks. So there's a question of to what extent do you want to complement or substitute banks. The reason I'm explaining that is this comes to the point of then financial sector development as a whole. Because to get development, we obviously need to go beyond simple transfers of money. We need credit, we need insurance, we need add-on to other services. So Safaricom's been extremely powerful and helpful in inverted commas in that regard, because what started to happen is banks and insurance companies and other firms have partnered with Safaricom and said, if you give us information on the transaction history of your customers, we can then develop credit scores and provide credit to them. And so we've had the explosion of these digital credit products where firms have access to information with Safaricom. There's, of course, then concerns about confidentiality, which we could talk about, that have enabled people to access credit, which then had its own problems, which we can also talk about, and insurance. So M-Pesa works in a powerful way as being a transfer system in Kenya. You can go an alternative path where you say mobile money firms are allowed to provide credit and insurance themselves. And so then they start to substitute for the banking system or substitute for insurance firms, which has its own trade-offs. One of the problems being you've then got to regulate these mobile money firms more extensively, which then makes it more costly for them to operate, which might mean they serve less underbanked communities. So these are the policy issues that evolve. And so it's how do the MISO institutions evolve over time? Which vision do they support? Complementing the banking system or substituting it? That's going to shape the future of the shadow banking system.
Yeah, and that's where we see the evolution or innovation in everything, institutional.
Yep.
So that's really, really helpful. So do we have more questions from our colleagues, friends? Wow. How fast we still have, okay, Jeffrey, you have a question, right?
Yes, I do.
Jeffrey.
Hello, can you hear me?
Yes.
Okay. Thank you, Jonathan, for your presentation. I'm not surprised that this system has worked well in Africa than what you see in the global north, because Africa, for example, has always used this local system of savings and money distribution, and is basically based on trust. So my what I see here is, would you say in this sort of system, trust is the key institutional factor here? So does that mean we sort of change how we look at institutional factors overall? Because we take it like what works in the global north, we know what we regard here as institutional factors, basically not the same in this area. But yeah, and where I'm going with this is how you describe the system in Kenya and other places. For example, you mentioned Nigeria, where banks, sometimes in most of money agents are controlled by the banks. Now, the reason for that is very simple, because when you say access to money or access to finance, you can define that in different ways. For example, in the UK, if I want a credit card, or if I don't have to provide a lot of information, banks here can easily go into the system and check my credit score within 5 minutes. That is another one way of defining access to finance. But the reason that some of these countries like Nigeria use this system is to gradually move these people into the formal system. Because when they are connected to the bank, it becomes easier for them because they engage in this information sharing system where, over time, these local people who operate in the informal system can go into the formal system. But if you don't have this with the M-Pesa, so would you say this is a disadvantage? So these are my two things. So would you say we take trust as one important institutional factor, and the difference between the the one controlled by the banks and the one that are not controlled by the banks. So would that be a disadvantage for the M-Pesa, for example? Thank you.
Thank you, Jeffrey. They're both great. They're great questions. Yes, in my view, trust is foundational to the economy. And what I'm trying to do in this paper is to ask really where that trust comes from. And because that's really what drives economies. So your specialization across strangers don't tend to trust each other off the bat. So because we know that people can lie, steal, and cheat. I'm often use the example when I talk to my students about this. I say, let's imagine that it's the night before you're going to move out of your student accommodation and you're going to move to California. You've got a Boston University apartment. You've rented it from Boston University. And during a party you hold the night before you leave, someone spills red wine behind the sofa. And you think, goodness, if I tell Boston University, my landlady, I might lose my bond and have to get that repainted or fixed. And I say to them, okay, would you tell them yes or no? You're going to California the next day. They're not going to be able to enforce the agreement against you once you leave. You'll never see them again. They're strangers. And most of my students say, oh, I would probably own up to it. And I say, how about if it's going to cost you $100 to repaint the wall? And some of them say, yeah, I'd maybe tell Boston University. And I say, how about if it had cost $500? How about $1,000? Some of them start saying, maybe I wouldn't tell Boston University. And I say, how about if it's your mother? And I say, there's only one answer to this. Yes, you tell your mother, right? Family members, you tell. You don't engage in lying and cheating. But with strangers, we're often tempted to do that if we can get away with it, particularly when there's lots of money involved. So one of the key to stimulating innovation and economic growth, this is the work of Douglas North, you've got to lower those transaction costs and enable strangers to trust each other. But the question is, where does that trust come from? And what I tried to argue is a lot of people seem to think, well, the theories suggest this is all you need. And what I'm arguing is that knowing that I can sue you in court if absolutely necessary, or the government's not going to come and steal my stuff, or we know who owns what, is just not enough for us to trust each other. Because so many other issues are going to involve that we need to resolve that are far beyond this problem. And I hope I explained a couple to you today. One of them is those residual control rights. Another is enforcing the agreement and ensuring fair treatment of agents. And another is addressing negative externalities. This level doesn't solve those problems. It's too broad. Politicians and courts don't usually deal with that. Instead, that's solved at a sector by sector level. So when you talk about I can use my bank and then firms from other sectors can use my information and they can provide these products, where does that trust come from? I bet you for most of us, it's not knowing we could potentially sue them in court, although I think most of us think we probably couldn't sue them in court. Instead, I think we trust the regulators, the informal norms, what's going on at this level that will protect against major transaction cost problems, major opportunistic behavior. So in terms of when it comes to Nigeria, because I know that there's been policy changes as MISO institutions have evolved over time, this gets to really the heart of the matter, that, okay, you can say the Central Bank of Nigeria could say, we want to favor banks because we think this is the path for development. So what they're doing is they're operating at this level. They're then saying we're going to design MISO institutions for mobile money that actually make it costly, increase their transaction costs compared to banks. So, for example, and this is what Nigeria used to do, is to say we're going to allocate those residual control rights that I mentioned to banks, and we're going to monitor these mobile money agents closely, which is fine, so long as banks have got an incentives to serve the unbanked. If banks say, okay, thanks for these residual control rights, we can dominate the mobile money sector and the banking sector. And by the way, we don't really care about the underbanked in Nigeria. Well, great, you've prioritized banks, but financial inclusion will never take off because the banks will never build branches into rural areas of Nigeria, not across the whole country. So there might be workarounds, You could say we're going to reform the MISO institution of banking to create incentives for mobile money firms, for banks to deliver financial inclusion. And a lot of countries have done this by allowing banks to use agents. So that picture I showed earlier of this intricate mobile money agent network, we're starting to see that for banks as well. So the question, I'm certainly not in favor of one model over another. But what I am arguing is that MISO institutional changes, not just the rules, the regulation per se, but how they evolve over time, will shape innovation generally across all countries, and will shape whether we have the bank-based approach or the mobile money-based approach. And I would argue, I certainly understand the appeal of the bank-based approach, but there's alternative ways of getting there. I mean, one of them option is to only work through banks, and another option is to facilitate partnerships between mobile money firms and banks, which is what we saw in Kenya. And I think one isn't necessarily better or worse than the other. To me, it all comes down to what lowers transaction costs the most in trying to serve the underbanked. If you take an economic logic, that'll probably deliver the most financial inclusion. If you go in there with preconceptions about wanting to favor mobile money firms or banks, then you might not be able to lower transaction costs as much as you want, which is not necessarily a problem, but it just means you might not get as much financial inclusion as you might hope.
That's really, really interesting session. I think everybody has learned quite a lot of things from different perspectives. So I would like to thank everybody who has contributed to the session, and particularly Jonathan, very good presentation. And I not only like the presentation itself, but also the contents. So thank you very much, Jonathan, for this good session. Do you have one sentence? Before I close the session, please.
Thank you so much, everybody, for having me. Thank you for the questions. It's a real thrill to get 15 people, I think, or so on the call. Your feedback's been really helpful for finalizing this book project. I'm glad that no one straight up contradicted me, just because I've got to submit this book to the publisher. So, but your comments have been really helpful. Thank you so much, and I'd love to engage with you in the future as this work evolves. Thank you so much.
Thank you very much. So thanks to everybody.